Are you an established small business owner or aspiring entrepreneur? Would you like professional advice to help your business grow and succeed? Well, look no further. The Virgin Islands Small Business Development Center is the territory's #1 resource to move your business forward. Enjoy no-cost advising, low-cost training, and technical assistance from experts in both the public and private sectors. The VISBDC is nationally accredited and sustained by the University of the Virgin Islands and the U.S. Small Business Administration. Visit us at our locations on St. Thomas, St. John, or St. Croix, and follow us on social media at VISBDC. For easy access to all our training and networking events, be sure to join our newsletter and download the VISBDC app. The Virgin Islands Small Business Development Center, here to help your business start, grow, and succeed.
Hi, good morning, everyone, and welcome to the VISBDC's hosting of Financial Statements 101, Understanding the Big Three. Today's session will introduce small business owners to the purpose and importance of the income statement, balance sheet, and cash flow statement. Our presenter will identify the key elements and sections of each financial statement. It's time to grasp the basic vocabulary of financial reporting. So today's lead presenter is VISBDC advisor, Mr. Darrell Edwards. Mr. Darrell Edwards is the managing member of Straight Path Consulting, LLC, a business established in 2011 in St. Thomas, United States Virgin Islands. The company offers a wide range of business, personal, financial, and career consulting services customized to serve customers' needs, such as analyzing business ideas, business plan preparation, promotional strategies, developing a personal financial plan, becoming financially secure, getting out of debt, college preparation, and etc. Darrell has counseled clients since 2001 while employed as a business counselor and later as a business consultant on a contractual basis with the VISBDC. He is also a part-time instructor at the University of the Virgin Islands, where he has taught small business management, Introduction to Business, and the Freshman Development Seminar since 2008. Darrell has also taught courses for the VISBDC in business plan preparation and managing personal finances. His educational background includes a Bachelor of Arts degree in business with a concentration in computer information systems from the University of the Virgin Islands, a Bachelor of Arts degree in accounting from the University of the Virgin Islands, a Master of Business Administration from the University of the Virgin Islands, and a certificate in personal financial planning from Florida State University. So here's a friendly reminder to place your questions in the chat, and they will be addressed by the presenting team either directly in the chat or later during our question and answer segment. A copy of today's presentation will be attached to the post-survey email, and we ask that you take a few minutes to fill out that survey that lets us know how we're doing. So without further ado, Mr. Edwards, the floor is yours.
Good morning, everyone. I trust everybody's doing well. I hope everybody's doing well. And so I was given a great introduction. I don't need to go through this again. It was given a great introduction by Sharika. So please, before we begin, make available a device that you could calculate numbers. I know we can do it on our phones. You could do it on a computer or even a calculator. Or if you want, you could use the abacus. I'm sure some people don't even know what that is. Make an advice, and you wouldn't really need it right now. We're probably during the middle of the presentation. You would need to be able to calculate some numbers. They're gonna make I do some work. It's the bottom line. So financial statements are very important to a business. It helps you make decisions. Now, keep in mind, financial statements are actual numbers of what has already happened. These are not projections. We covered projecting sales on Wednesday. What we're speaking about today is actual recording of the transaction that already happened, historical numbers. So even if you're not a financial person, even if you might not be the one who prepares your financial statements, it's always good to be familiar with what the content is in these statements. And these are the three most common statements. Trust me, there's other statements besides these three, but these are the top three. And I would suggest that you prepare them in this order. This is just my personal opinion, that they be prepared in this order. First, you start with the cash flow statement, then the income statement or the P&L, profit and loss, and then the balance sheet. So the first statement, as we said, is the cash flow statement. Remember, for a business, cash is king. Cash is the lifeblood of a business. And the cash flow statement is the concept of it is very simple. The amount of cash that's coming in versus the amount of cash that's going out. It's very, very, very simple and very straightforward. It's nothing complicated about it. I prefer and I recommend that you prepare this statement on a monthly basis. The reason why is that if you do it on a monthly basis, it's going to reflect the repayment of loans. A lot of the loans that we have to repay, even some of the debt that we have to pay, or some of our expenses are done on a monthly basis. So it's good to see how your payment affects the cash flow. That's why I would encourage you to do it on a monthly basis. And it also shows seasonality. So you can see in these months, we had more cash, or we had less cash because of seasonality. And in the cash flow statement, you do not include any non-cash transactions such as depreciation. And the reason why I said you should prepare this statement first is that the cash flow statement usually feeds into the other statements. So we're going to take a look at an example of a cash flow statement. So I'm sure you're seeing now my fictitious business, Daryl's Gift Shop, and the 2025 cash flow statement. So I want to take a while to look at it. This is what they call the indirect method. There's a direct method of preparing cash flow statements that's a little bit more complicated. But for the sake of simplicity, let's look at the indirect statement. And it's lined out very carefully. You notice the first column after, you have the description of the items to the far left, but you notice that the second column, we should say, is the pre-loan. And it's not included in the January, February, etc. These are the things that happen before you get into your operating cycle. The operating cycle is, begins from January to December. So all of these things occurred before the cycle. For example, we had a loan of $50,000. That's where the loan proceeds says $50,000. The $5,000 opening cash equity, that's how much we contributed to the business. So we contributed $5,000 and we got a loan for $50,000. So our total cash receipts is $55,000. And then we have the disbursement of that $55,000. 15 went to inventory. We did some improvements, etc., etc. So cash flow statement is very simple to understand. You notice that for the sales now, we didn't put any sales in the pre-loan column, but the sales began in January, etc. So you notice for January through May, we have $25,000 per month. Then in June, we had a dip in sales. So this is why I recommend that you prepare it on a monthly basis so you could see those dips. You could see, okay, start in June, because usually that's the time when businesses slow down. Apparently, this is a tourist-based business because we don't have that many tourists during this time. And then it picks up again in November with the $25,000 per month. The inventory, before the cycle began, we spent 15,000 in inventory, and that's why for January we didn't spend any in inventory. This 15,000, we kind of put it into the cycle for January. But since it came before the cycle, we put it outside of the cycle. We have the items rent. When I look at rent, I say, boy, this had to have been prepared a while back because it's hard to find a decent place for 2,500. And you have the other expenses. Notice I'm paying myself. Hello. I'm paying, well, I did pay myself. This is not unprojected. This is the actual. So I did pay myself and etc. So I think it's very straightforward. So at this point, is there any questions about this statement? Let me scroll up so you could see everything. And you notice in the slower months, the cash surplus or deficit, we had a loss in these months because we made less money at the top. So we had a deficit. That's why it's in red. The numbers in red mean you lost money that particular month. And that's why it's good to prepare it on a monthly basis so you can see what months are challenging. So if you have any questions about this particular statement, let us know. Put it in the chat. I see something in the chat. There's something in the chat, Sharika?
Yes, so is this the same as profit and loss statement?
No,
Don't
this
they
is
show the same
this is the
thing?
cash flow statement.
Okay.
That's the one question. There's another question.
To add to that, someone was asking if they show the same thing.
If what?
If they show the same thing.
Okay.
If the profit and loss.
This shows they're very similar. The cash flow and the profit and loss of the income statement are very similar, but you're going to see one of the major differences as we get into the income statement.
And we have another question. Would you clarify where the deficit took place?
Okay, the deficit took place. It took place in June, July, August, September. If you notice with the sales for those months are less. The sales for the January through May is 25,000 per month. But when we hit June, because we don't have that many ships coming in June, through September, we had fewer sales. I had a client one time, of course, this was a projection. In his projection, he projected September as 0. He said he's going to close the business in September. He's going to temporarily lay off. So for September, that entire column was zeros. Zeros for sales, zeros for expenses. He totally closed down the business in September because, that's the quote unquote hurricane month. So, but yeah, during those months. So to answer the question, it's in those months where we had the deficit. It's in June, July, August, September.
And we have another
And
question.
October. Yeah, we had one in October as well.
Here's another question. I see that there was no change in payroll as owner. And is there a time when you will have to consider reducing the owner's payments?
Obviously, it seems like I saw that I had enough cash to pay myself. Many business owners do not pay themselves, especially in the first couple of years of operation. But yes, that is very important. And I'll let you guys know this as well as a business owner, a real business owner. Of course, this one is a fictitious business, but as a real business owner, what I do is I take a percentage of everything that the business makes, as opposed to, yes, there's $1,000 a month. What a lot of business owners do is they do what they call an owner's draw. They look at the receipts for the month and they say, how much could I take? But the $1,000 a month, I guess I looked at those receipts and I said, I could take $1,000 a month. Many business owners, if they see this for their first year in business, they would be jumping for joy. If they could pay themselves, especially for a retail business, they could pay themselves $1,000 a month. They'll be jumping for joy. But you guys find some good questions.
We have one more. Is the income statement actual or projected?
Everything here is actual. Everything, I'm so accustomed of doing, most of the work that I do is projected. This is actual. You're actually recording what has happened already. Of course, we haven't reached the end of 2025, so you know that this is fictitious. But if this would be on December 31st, so to speak, 2025. So this is actual. These are actual. It's a fictitious business, but it's supposed to be actual. Any other questions? You notice that the gross receipts also kind of mirrored the sales. With the gross receipts for January through May, we paid 1,250. In the slower months, we paid 788 because we made less money. So the gross receipt is it's a local tax that comes from your gross. It's not a sales tax. It's like, it takes it right off the top from your gross.
Here's another question.
Mhm.
The threshold for sales would be 25,000. Therefore, anything less would be
I didn't know
that.
Okay, he said the what?
The threshold for sales would be 25,000.
1,000.
Considered
It's not really a threshold. And remember, we're not projecting. We're recording what actually happened. Okay, I just threw in some numbers, but we're recording what actually happened. If I own Daryl's gift shop, and it would be nice if I could own another business, and at the end of the year, end of 2025, I'm recording exactly what happened. Now, you know, in real life, you know, the numbers don't come so nice and neat, 25,000. You know, it doesn't happen like that. But I just threw it in just for presentation purposes. See, we have a couple more questions.
No, the last part of that question was where would I write my projection to know that?
Oh, the projection is something so totally separate. When, for example, if you are applying to the bank for a loan, you have to present them this information, your actuals. They're going to want to see your actuals. They're going to want to see projections as well. But if you are an existing business, they're going to want to see what you actually did. So they could kind of make a comparison. Because sometimes we have a big difference between what actually happened and what clients project. So banks so I want you guys to keep in mind as we're going through this, these are actual numbers, not projections. Projections are a totally separate document.
And that takes care of our questions for now.
Okay, for now. You might have additional questions as we go through, right? But for now, those are the questions. Okay, so back to our presentation. We already had the sample. So now we look at the income statement. I learned it as an accounting student. I learned it as the income statement. So when people started to say P&L or profit and loss, someone, what are you guys talking about? But it's basically the same thing. Profit and loss, income statement, same difference, so to speak. It records income and expenses, just like the cash flow. However, it includes depreciation. Somebody asked the question, what's the difference between the cash flow and the income statement? This is one of the big differences. On the income statement, you have to show depreciation. And we're going to explain depreciation in greater detail when we come to the balance sheet. But it does record depreciation expense, which it's kind of interesting why you have to record depreciation expense, because it's not really an expense where you actually spend money. It can be on a monthly basis. Some businesses are required to prepare an income statement on a quarterly basis. For example, if you're a publicly traded business, you have to prepare a quarterly income statement. I prefer annual basis because of the depreciation. You can show the depreciation even if you do it quarterly or monthly, but it's just going to be partial, and it just makes it a little less clean. It's cleaner if it's done on an annual basis. And again, another difference, many of the loan proceeds transactions are not included. If you remember from the cash flow statement, we included the money that we got from the loan. If you recall, we got the 50,000 from the loan and the 5,000 that we invested. These transactions are not included in the income statement. The income statement is solely what the business does generate. Okay, so let's go back to that briefly. Go back to, okay, we briefly back to the cash flow statement. See this opening cash equity of 5,000, not going to be on the income statement. The loan proceeds of 50,000, it's not going to be, it's going to be, the repayment is going to be on the income statement, but the infusion of cash, this 50,000, is not going to be on the income statement. It's not income generated by the business. It could be argued that the business applied for the loan and they received it, but it's not generated from the operation of the business. So it's not included in the income statement. These are some key terms for the income statement. If the business sells products, and this only applies to businesses that sell products, there's going to be a line for cost of goods sold. And the cost of goods sold are the products, the cost of the products that were sold by the business, and includes the cost of the material. If you're manufacturing your inventory, there's some businesses that actually manufacture their own inventory, as opposed to purchasing something and reselling it. Some businesses actually manufacture it. So if you manufacture it, it's going to be the cost of the materials that were used to manufacture the product, plus the labor of the workers who were part of the manufacturing of the product. So that's why I always encourage my clients that you have to know what your cost per is. Cost per is the cost of each item that you're going to sell. Sometimes when I ask clients, what's your cost per? Clients manufacture. I have clients who manufacture things such as dolls. Some businesses manufacture drinks. Whatever you manufacture, you need to know what is the cost to produce one unit, one doll, one drink, one whatever you produce, if you're producing it. If you purchase it, it's easy. You just know the cost of it. But even when you purchase items, you have to include the shipping as well. And we all know in the US Virgin Islands, since a lot of things are shipped in, that could really make a difference in our costs. And of course, that's going to affect the price as well. Somebody have a question? Because I see you seem like, I don't know if this pertains to what we're speaking about.
Are grants treated the same as a loan not being included in the cash flow statement?
Exactly. Anything that's not generated from the operation of the business is not included. So the grant would not be included. It would be included in the cash flow, but not in the income statement. It would be included on the balance sheet as well. The infusion of the cash would be shown on the balance sheet as well, but not in the income statement. That's one of the biggest items. So the reason why the income statement is so important is that there's some businesses, the owner, just like how you saw that I got a loan for 50,000, there's some businesses where the owner themselves could put in 50,000. They have it like that, so to speak. So that separates them from a business who has to kind of struggle or apply for a loan to get their 50,000. So the source of the money is very important for the income statement. The gross profit is you subtract the sales or revenues. And by the way, as I mentioned on Wednesday for the projecting sales and revenues are terms that can be used interchangeably. I learned as an accounting student, sales are for products and revenues are for services. But I've seen them used interchangeably, even by CPAs. Statements that CPAs prepare, I've seen them use revenues for sales, for sales of products, and sales for products. I mean for services. So when you subtract the cost of goods sold, sometimes it's called the cost of sales. You subtract the cost of goods sold from the sales, that gives you the gross profit. or the gross margin. It's the same thing. And then the next thing you do is you list the expenses. After the gross profit, you list the expenses. We're going to see a sample, so you'll see exactly what I'm speaking about. Then we have the operating expenses. These expenses directly related to the operation of the business. The loan interest, this is interesting. The loan interest payments are included as an operating expense, but the principal payments are not. You know, when you have a loan, the payment that you make is divided into, some of it goes to interest, usually at the beginning. Some of it goes to interest, some of it goes directly to the principal. The part that goes to the interest is an operating expense, but the part that goes to the principal is not. I find that very interesting. Some people will just lump in the entire payment as an operating expense, but it's not. And believe it or not, that's something I learned after I began to work with SBDC. Because I searched through my accounting books, and maybe it's there and I didn't see it, but I didn't see it in any of my accounting books. Depreciation expense, that's a decrease in value of assets over time. As I said before, we're going to get more into depreciation as we speak about the balance sheet. But depreciation expense is not an expense that you actually pay money for. The decrease in the value of assets, for example, if you have a vehicle, the useful life of a vehicle is usually 5 to 7 years. So every year you divide the value of the vehicle by 5 or 7 years, whichever number you're going to use. And every year you have to report the depreciation expense. Why that is, I guess people who know more than me have determined that you need to include that as an expense, even though you're not paying any money. You still have to include it as an expense. Then we have the net income from operations. After you subtract your operating expenses, you're going to get your net income from operations. This is the gross profit minus the operating expenses. And this indicates the profitability of the business's operation. And then you have the bottom line net income. This is like after all the taxes and the loan principal payments, we have the net income. There's some very important relationships. The ratio of sales to cost of goods sold. You take the sales and you divide it by the cost of goods sold, and that's going to tell you how many times the inventory was marked up. Because it should give you a whole number. If it gives you a fraction, then you might have to reevaluate your prices because probably your prices are too low, or the cost, maybe your costs for the items are too high. I don't know if you could see if you could get another source of purchasing your items, or if you manufacture, find a different way to manufacture, a cheaper, a more inexpensive way to manufacture the items. And then we have the flip of it. You take the cost of goods sold and you divide it by the sales. And that gives you the percentage of sales that goes directly into costs. And let's look at the sample so you'll get a chance to see everything that we just discussed. So we have the income statement. Notice that you have to state what period this is for. This is for the period January 1st to December 31st. The sales, this is the same as the cost of sales, the same, 253 is the same. The cost of goods sold. This is, as we just mentioned, the cost of the items that we sold. Since we're selling items, we have a cost of sales. You subtract the cost of goods sold from the sales and you get your gross profit, a gross margin. And then we have the operating expenses, 30,000 in rent, etc., etc., etc. Payroll taxes, all of this was taken directly from the cash flow statement. So that's why I encourage the cash flow statement be prepared first, because it feeds in to the other statements. And actually, I noticed this when I was looking at it yesterday. I noticed that technically this is not correct in this sense that my business is an LLC. right? And as a LLC, the entity itself is not taxed. The entity is not taxed. The taxes pass through to the owners or the members. So technically, I really shouldn't have a tax liability. Now, what some people do, unless you tax it as a corporation, so my excuse for my error is that I tax it as a corporation. But it really shouldn't be there. When I do my taxes, I don't subtract the income taxes. The tax liability passes through directly to the owners with the LLC, unless you're being taxed as a corporation. And LLCs, they have the election. They determine how they want to be taxed. You want to be taxed as a sole proprietor in the case of a single owner, like myself, or you could be taxed like a corporation. Excuse me. You make that decision as a LLC. You make that decision. You notice that we added back depreciation because why it was added back? Because it's not a cash transaction. You don't have to pay somebody for your depreciation. You don't make a payment. So that's why we added back, just so we could be accurate. And here we added the principal payments. You notice that the loan interest payments was in the operating expenses, but the principal payments were not until we here the loan principal payment is 9,000. So this is our bottom line. Our bottom line is 4,271.
So, Mr.
I
Ed,
remember one
a question.
Go ahead.
If I resell items, can you explain again how the cost of goods sold line item would operate? Is that where I would put the expense of buying the products?
Okay, the cost of sales, let me go back. I'm going to go back to the presentation because that has a detailed explanation of the cost of sales. The cost of goods sold is the cost of the product sold. And this cost, it depends on how you acquire your products. If you purchase them, it's rather easy to do. You just take the cost of purchasing the products plus the shipping, as I mentioned before. You have to factor in the shipping. That has to be added in. So you have to determine what's the cost per the item. If you manufacture the products, if you're manufacturing your own products and then selling them, then it's the cost of the materials plus the cost of labor. And that's how you determine the cost of sales. It's a little bit more detailed than that, but for sake of our discussion, that's the easiest way to describe the cost of sales. So I'm hoping that I answered that question. So you notice that the cost of sales is a lot lower than the sales, which is a good thing. If the cost of sales is higher, then that would encourage you to make some decisions about your prices. Are your prices too low? Or is the cost of your items too high? You have to look at the source of your items. So we're going to discuss that in a little bit in greater detail. Now, I remember one time I was giving a presentation to some students who had a UVI for this summer program for high school juniors and seniors in business. And I used these same numbers. And they had one of the students in the class was kind of laughing. He said, you operate this business and at the end, you only get 4,000 at the end. So he was kind of laughing at that, right? So I had to call him out. I had to kind of put him in his place. I had to explain to him, look, and of course I did it from the standpoint of projections, but this is supposed to be actual, but I did it as projections. I tell him, look, most of my retail business clients, if they have these numbers after the first year, many of them would be jumping for joy. Because in the first year for retail, a lot of times you lose money. much less have an opportunity to pay yourself $1,000 a month. So I had to put him in his place so he could really understand. Reality, 4,000 is not a lot of money, but for a startup business first year, and the owner could pay themselves, ooh, some people will be jumping for joy. That's the reality. So any other questions concerning the income statement?
I don't see any in the chat at this time.
Okay, so let's go back to the presentation. And I have some questions for you guys. Remember I told you guys to, we did this already. I told you guys to get something where you could do some calculations. So what you're going to do is you're going to determine how many times I mark up my inventory. And you're going to determine for every dollar that I make, how much of it goes directly into cost. And of course, I have to show you the numbers again, because I don't think you memorize the numbers. So, and I'll actually show you guys what to do. You're going to calculate how many times do I mark up my inventory and what percentage goes directly into cost. So let's go back to the income statement. To determine how much you mark up the inventory, you take the sales and you divide it by the cost of sales. So that's pretty straightforward. So you take the sales and divide it by the cost of sales. It should give you a whole number, point, whatever. If it gives you a fraction, that means that the cost of sales was higher than the sales, which is a problem. So it should give you a whole number. And that shows you how many times you've marked up your inventory. So I'm not going to take your answers yet, but I want you to calculate that. Take the sales and divide it by the cost of sales. That's the first thing. Then the second thing you do is you do the opposite. You take the cost of sales and you divide it by the sales. So you're going to flip the equation around. And what that is going to tell you is for every dollar that is earned, what percentage goes into direct cost. The cost of goods sold is considered a direct cost. So for every dollar you make, what percentage goes directly into cost? And those are very important things. Now, this only applies for businesses that sell products. I have seen CPAs prepare financial statements where they have the costs of services. That's not really a requirement. There might be some benefit of doing that. I guess you could see the cost of how much each service is, but it's not required. The cost of goods sold is definitely a requirement. So now I'm hoping that you guys understand what you have to do. Take this and divide it by this, and then flip it, take this and divide it by that. So we're going to go back to the presentation. And
we already have comments in the chat.
What are the comments?
4.5 times inventory marked up. So 22.2% sales go into cost.
Do we have any different numbers? Are any numbers different? I see more than one person. That's what one person had, or more than one person had that answer?
That's just one person's response.
One person's answer. Okay.
Yeah.
Well, drum roll, please. That person is exactly correct.
Yeah, people saying correct and they got the same.
Yeah, okay. So, yes. So when I look at the income statement, that's the first thing I look at. I look at the relationship between, if it's a business that sells products, I look at that relationship. So I'm marking up my inventory 4.5 times. Is that good or bad? A lot of it determines on the items you're selling. There are many businesses that only mark it up twice, for whatever reason. Some people, when they realize how many times things are marked up, they get very upset because they realize that a lot of these items are basically sold for pennies and they're marked up many times. And of course, the excuse that the business owners use is shipping. And like I said, you do have to factor in shipping into the equation. But yeah. And the same thing with the, for every dollar that I make, 22 cents is going into sales. That's very good. In most industries, it's usually like 30%, 30 cents for every dollar. And whether it's good or bad is determined by the industry. The certain industries marking it up 10 times is a norm. Some industries only having 10 cents going into direct costs or cost of goods sold is the norm. It depends on the industry. And how do we determine that? These are some I want you to check out. Now, base stats, the information for base stats is kind of old. Last time I checked it out, I'm hoping it's still online. Last time I checked it out, it was from 2015 or 2000. It was old, but I could use that as a basis, as a foundation, even though it's old. Risk management, I think risk management is more up to date. The only thing about risk management is, at least at the time when I was working with SBDC full-time, they never incorporated the US Virgin Islands into the data. Risk management has a bunch of data about different areas based on the population. So even if you take the population of the Virgin Islands, which is supposed to be what, 88,000 based on the last census, or even St. Thomas, which is like 40-something thousand, you can't really apply it to a town or county in the US that has a similar population because we're on an island. So the industry is going to be different. So now I understand that a lot of the banks locally use RMA. That's kind of surprising to me because it does not factor in, being in the US Virgin Islands, but a lot of them use it. That's what I heard. A lot of them use it.
So we had a question. Are there set up markup percentages?
Are they what?
Are there set markup percentages? Sorry.
As I was saying, it depends on the industry.
Okay.
And yeah, it depends on the industry. And as I said, in the US Virgin Islands, it's kind of difficult to determine because though a lot of these companies, even BizStats or RMA, they don't factor in the US Virgin Islands. And as you guys know, doing business in the Virgin Islands is something totally unique. So you're gonna have to kind of play it by ear, so to speak, with our stats. We're not good with stats, and some of it is because a lot of these entities don't include us in their stats. So when you have a chance, and you will get a copy of this presentation. So when you get a chance, you look up BizStats. Like I said, the information of BizStats, if you look at the bottom and see the last date that was updated, is very old. Not very old, by a couple of years, at least maybe 10, 15 years old. But you could kind of use it as a baseline. And then you'll have to kind of factor in what happens locally. So, but that's your answer for what is available. The balance sheet is a snapshot of the business's financial position. It is as of a specific date. If you remember with the income statement, it's not for a date, it's for a period. This is the income statement for the period January 1st to December 31st. But the balance sheet, this will be as of December 31st, as opposed to being in a range of dates. So it's like a snapshot. You're taking a snapshot. When you take a picture, this picture was taken on a specific date. When you're using a film, sometimes the film could go over a period of hours and minutes or whatever, but a snapshot is of this is at this particular time. So that's one of the biggest differences with the balance sheet. It indicates how the business's finances are being managed. I call this balance sheet the truth. I do a little bit of investing. I'm not a professional investor, but I do some investing. And one of the things they encourage us to do, before you invest in a company, look at the balance sheet. You would look at the income statement and the cash flow statements as well, but they urge you to look at the balance sheet because that's going to tell you a lot about how the company is managing the business. The income statement is going to tell you how much they're earning, but how are they managing it? You know, earning and managing is two separate things. The base value of the fixed assets remain the same from year to year. The overall value of these assets is decreased by accumulated depreciation. You're going to see that in the example. And the reason why they call it a balance sheet is that the figures have to balance. The assets has to equal the liabilities plus the equity. So if you subtract the liabilities from the assets, you get the equity. Some key definition: assets is what you own. Assets can be fixed and they could be intangible. A fixed asset is something you could touch, like a desk, equipment. Those are tangible fixed assets. Intangible assets are things like copyrights and patents. You can't really touch. You could touch the paper that that gives you the right, but you can't touch the right itself. Liquidity is how easy an asset can be converted into cash. A current asset is an asset that should be converted into cash within a year. Cash is already cash, so cash is very liquid. When you hear that a company is liquidating, that means it's selling stuff to get cash. Okay. Accounts receivable is money owed to the business for the sales of goods and items. This is not personal that you lend $1,000 to your cousin on a personal basis. It's not unless you borrowed it from the business, unless the cousin borrowed it from the business, it's not a business transaction. Business transactions only. And we said before, fixed assets are what you can touch. Accumulated depreciation is a running total of the depreciation of the assets. And you're going to see the example. You're going to see it clear when you see the example. These are the useful lives, because this is used to determine your depreciation. For example, furniture or fixtures, the useful life is 5 years. Now, this doesn't mean that after 5 years you throw it out, but for accounting purposes. And this is where it goes against the business owner to have older fixed assets. You could have some furniture or fixtures that are well over 5 years, but for accounting purposes, you have to take them off the books after 5 years. Even though you've taken good care of it and it looks real nice, at the end of 5 years, you got to take it off the book as an asset. It's hard, but it's fair. And you see the useful assets for the different items. Building and improvements is a range. So I usually, when I'm working with this for a client, I usually do this based on what's going to be to their advantage. If it's their advantage to use a useful life in 10 years, I'll give it 10 years. Or if it's 39 years, I'll give it 39 years based on what's beneficial to the client. Liabilities are what you owe as opposed to what you own. The asset is what you own. Liability is what you owe. Credit cards, business loans, etc. Those are current liabilities are liabilities that have to be repaid within a year. So if you have a loan, what you're really supposed to do on your balance sheet, if you have a loan, the portion that's supposed to be repaid within a year, you put that under current liabilities. And then you subtract that from your balance, and then the rest of it you put under liabilities or note payable or whatever. Accounts payable for the business owned, usually for purchases for goods and services. As we said, you separate the long term from the short term. Notes payable is a liability that has a note, like a loan, you have a note for the loan. The equity, it reflects the assets, subtract less the liabilities, so approximate valuation of the business. And the return earnings is the net income at the end of the period. The things to watch out for with the balance sheet: cash. You want to make sure you have enough cash to cover your liabilities. If a business has a lot of receivables, that could be a problem because a lot of times the receivables are not considered to be payable. A lot of time they ain't gonna pay you again. If they haven't paid you after a certain time, they're not gonna pay you again. A large amount of inventory can be good or it can be bad, depending on the nature of the inventory. And if you have a lot of depreciation, it could mean that you have old assets. So let's look at our sample balance sheet. You notice this is as of December 31st. So it's not a range. The income statement is a range from this period to this period. The balance sheet is as a specific day. It's like a snapshot, taking a picture. It's a specific time period. And the assets are listed, even the liabilities are listed based on what they call liquidity. As we said, liquidity is the ability to turn these assets into cash. Since cash is already cash, you list it first. You usually list cash first. These are the balances at the end of this period. On this particular day, December 31st, 2025, these are the balances. This is how much I have in cash. This is how much I have in receivables, inventory, etc., etc. The fixed assets, these are the balances, less the depreciation. You have to take off the depreciation. Even a leasehold improvement, that's an asset. You're renting from somebody, and the improvements that you make in the place, what people call the build out, that's an asset for you. It could be an asset for the owner of the building as well, because you can't take it with you. You could take the equipment with you, but you can't take all of the work that you did to fix up this place. You can't take it with you, but it's counted as an asset for you as well. Even a deposit that you make on the lease, you consider that an asset as well. So total assets is 65 plus. Then you take the liability. See what we did? We took the notes payable. We took the current portion. This 9,004, this is the amount we have to pay within a year. And if you add the 94 plus the 31, that would be our total liability, or total note, so to speak. The retained earnings, you notice that it came exactly from the this 4271. And it balances the assets, 65, equals the equity and liability. So that's why it's called a balance sheet. Comments, questions on the balance sheet?
I don't see any questions on this as yet, but we did have one that stated, could another reason why we are not reported in BizStats is that many businesses are on a cash basis?
That's a possibility. I think it's just that we're territory and not a state. And so a lot of these companies just focus on the 50 states. They don't focus on the territories. I'm not sure if Puerto Rico is there as well. So to answer your question, I think it's because of the fact that we're territory. So a lot of people don't know that we even exist. I think that's the reason. You'd have to ask the companies why they don't include us.
And here's a question in reference to this. Does assets equal equity plus liability?
You take the assets. Yes, you're correct. So the assets is 65, and you add the equity and liability is 65. Yes, you're correct.
Which leads to another question. Fixed assets equals liabilities minus depreciation?
Fixed assets equals the value of the assets, then you subtract the depreciation. But the fixed assets would be things like, in this case, is leasehold improvements and the equipment. And then you subtract the depreciation from it. Right now it would be 27.5, but if you subtract the depreciation, it's 4. And if you notice, this 4,100, it's a depreciation expense. This is how much you take off every year. As we said before, it's not a cash transaction. It's not something you take out, you take a check and you write it for 4,100 and pay to anybody. But the people who created the generally accepted accounting principles, they say that you should take this out as an expense, even though you're not paying anybody for it. That's why we added it back to get the final number. Any other questions concerning the balance sheet?
No more questions at the moment.
Okay. So we're just about hitting the end of our, let me go back to the presentation. And I know we're not going to have time to do this. We don't have time, but remember, this is going to be part of your, you're going to get a copy of this, so you'll be able to do this. So what we'll do is you could take your questions now. But if you don't have any questions, we're going to go through this. Again, another fictitious business. Today is December 31st. And the name of the business is Financial Statements 101. So in 2025, this is what happened. Our opening cash balance was this, etc., etc., etc. So what we want you guys to do, and like I said, we basically wrapping up. Put these numbers where they're supposed to go. Some of them would go in the cash flow statement. Some of them would go in the income statement. Some of them would go in the balance sheet. Some of them might go, some parts of them might go in the all statements. Or if you can't do all of them, do a couple of them and let me know what you got. But like I said, in the meantime, let's take the questions as you go through this. Any questions concerning it? It doesn't have to be about this. It could be about anything that we discussed earlier. Any other questions? I'll give it a few minutes, then I'll show you guys the solution. So where would the opening cash balance go? Where would that one go? $300,000 in sales. Where would that one go?
Someone responded cash flow statement.
Yes, the 7,005 would definitely go directly into the cash flow statement.
Someone else said opening cash on the cash flow statement.
Yep, exactly.
Someone said sales, cash flow, and income statements.
For what? For what? For which one? It says sales. Oh, the sales. Yeah, the sales, right. The sales would be, excuse me, on the cash flow statement, definitely the income statement, and it would affect the balance sheet as well. What about the cost of goods sold?
Someone replied income statement.
Exactly. The payroll, 6,003. I think it's supposed to be 6,002.
Payroll goes on the income statement.
Yeah, it goes on the cash flow too, but I noticed that I made an error. It's supposed to be 6,250 instead of 6,3. The deposit on the rent, you rent in a location, it's 4,000 a month, and they ask you for 8,000. They ask you for first and last, or first and security. So where would the 8,000 go? It was paid before the business opened.
Deposit, income statement, and balance sheet.
Deposit would go, it's not part of the business operation, so it would go on the balance sheet as a other asset. The rental payment, the 4,000 per month, that would go on the income statement. The 250 per month for promotions.
Promotions go on the income statement.
Yes, and it will go on the cash flow statement too, assuming that you're paying cash for these promotions. 500 per month for electricity.
Electricity, cash flow, and income statement.
Yep. And it would affect the balance sheet, but it wouldn't be directly on the balance sheet. 2,500 for business license and fees. I think I might have left that out of one of the statements. As you're gonna see the statement.
License and fees, cash flow, and income statement.
Yep. We have a loan balance of 30,000, but 10,000 is due within a year.
Loan balance, income statement, and balance sheet.
Okay, yeah, what I did on the cash flow, I didn't put the loan repayments. I should have put them, but I didn't. But the loan balance, you have 10,000 that's due within a year. So that would be what we call a current liability. So you'd put the 10,000 separate from the 20,000, which would be a long-term note payable. So it'd be 20,000 current and 20,000 long-term. You have 20,000 in equipment, which was purchased before the business opened. And the equipment is a year old.
Equipment depreciation and balance sheet.
Yes. And the inventory balance is 10,000. This is how much inventory is as of December 31st, our inventory balance is 10,000. Where would that go?
Inventory balance goes on the balance sheet.
Just like what it says. Absolutely correct. So you guys got 100. So like I said, I think I made some errors on this. There it is. I made some errors on it. For the payroll, like I said, it's 6.2, not 6.3. I'm gonna make that change. It's 6.2. Actually, I should have put the 8,000 here for rent. The 8,000 deposit, I should have put that there as well. We're just slapping together some numbers. And then we have the financial statement. Again, you put the 300,000 in sales and 90,000 in cost of sales, the rent, electricity, payroll. I didn't put the payroll taxes. Let's try to make it simple. The promotion, 250 a month. Security, I thought I took this out. We didn't have any security. I need to take that out. Licensing and fees and the depreciation. $10,000 inventory balance. 4,000 depreciation. See, 4,000 a year. Deposit on the lease is the 8,000. The retained earnings is 74900, 74900. Like I said, I did make some errors in this. So I was just slapping together some numbers so we could have a sample. So I made some small errors, but I'll fix them up and you'll get to, when the version you get should have the corrections in them. Okay. So that's it for me. I'm done. Finito. You guys have been great. I really appreciate the questions and the interaction. If you need to contact me directly, as I said before, in 45 minutes, I'm not going to get you guys to be accountants in 45 minutes. It takes a longer time than that. But at least you should know what these things mean. So when you see them on the statements, even if you don't prepare the statements yourself, when you look at the statements, you could say, hey, how come this is this? How come this is that? And then if the numbers are not to your liking, you could say, okay, what do we need to do? Our costs of sales are very high compared to our sales. That means we probably need to raise our prices, or we need to find a different place to get our items from. Why is it like this? So it helps you to make decisions for your business. So feel free to contact me. You have my contact number there. It's easier to contact me through the VISBDC. Sign up to be an SBDC client, and then you can be assigned to me. So it's easier if you just go directly to the VISBDC. Any other questions? Feel free. I really enjoyed working with you guys. I love the questions. So that shows that you're at least listening and watching. So I really enjoy the interaction. Any other question before we close it out?
I don't see any questions, but I do see comments. This
Okay.
was a great overview. Thank you. Excellent presentation. Thank you, and I learned so much. Thank you for your time. It was an informative session. Have a great rest of your day. Thanks. Everyone saying it was great.
Wonderful comments. I'll just say this, right? People always tell me, thank me for my time, but I tell people, whenever you book my time, whether you sign up for a presentation or if you book my time as an individual consultant, it's not my time anymore, it's your time. So I do appreciate the comment, but that's how I look at it. I look at it, you book the time with me, and so it's your time. So I try to make the best of your time. It's not my time anymore. So I'm hoping to see you guys as clients of the SBDC if you're not clients already.
Alrighty. So the VISPDC has so much more in store for you as VI small businesses. You can visit our website at www.vispdc.org. Download the VISPDC app on your mobile device from the appropriate app store. Like and follow us on Facebook, Instagram, Twitter, Google Business, and subscribe to the VISPDC YouTube channel for new uploads of our on-demand webinars. Just to make mention of a few training events we have coming up, we want to mention the importance of how to keep production and sale records, part 1. And this is in collaboration with the Agriculture Business Center. That's going to be on August 5th from 5 to 6:30 p.m. And then part 2 would be on August 7th from 5 to 6:30 p.m. On August 19th, we have the SBA presenting how to apply and qualify for an SBA loan. That's going to be hosted by the Senior Area Manager, Mr. Wayne Huddleston. We have a customer service webinar coming up on August 22nd. And it's entitled Small Business, Big Service, Crafting Unforgettable Customer Experiences. On August 26th, we have our SBA webinar Tuesday, returning with learn about SBA's resources to help your business start, grow, and succeed. And we also have an AI integration series. We have how to develop and maintain, we have Intro to AI at the Business Wheel. We have AI in financials and operations, and we have 2 more. And we also have 2 marketing webinars coming up. How to develop and maintain a strong brand, keeping your small business relevant, and the importance of creative advertising and marketing, smart spending for small businesses, in terms of marketing outside of the box. So we encourage you to go to our training portal on our website, sign up for as many webinars as you wish. And I don't see any additional comments. So once again, we want you to check your email. A copy of today's presentation will be attached. And we want you to fill out that survey that lets us know how we're doing. So on behalf of the entire VISBDC network, we thank you for your time and attendance today, and we hope that you enjoy your weekend.